Assalamu alaikum. Welcome to lecture 16 of AAA. This is the first lecture under your section E, that is completion, review and reporting, which is subsequent event and going concern. So here we are going to focus on subsequent event and going concern. Okay. In this lecture, we are going to finish. We are only going to work on two parts. Okay. In the completion and the review stage of the audit, there are many things that we have to do. More information we need to look for. For example, we have to review, we have to evaluate misstatement, we have to get written representation from management, do a final analytical procedure. We have to see whether there are any going concern issues or not, and some subsequent event we have to look for. Out of the 6, 2 will be completed in this lecture. The remaining 4 will be completed in the next lecture. Okay, so we are going to start with exam focus. From the point of the exam, you will get at least one question which focuses on section E of your AAA syllabus, that is completion, review and reporting. Okay, so for this you have to read reason event. Okay, you have to look for reason financial statement, any reason information, new information that is given to you in the scenario, there you need to look for. Okay, because reason event, if there is any reason event that is taking place, this may result either adjustment in the financial statement or a disclosure note. If not adjustment, then at least you need to disclose either of those two. Okay, so auditor needs to evaluate the effect of any uncorrected misstatement on their opinion. Okay, and in the exam you may have to evaluate misstatement and suggest the audit procedure to reach a conclusion. Okay, now subsequent event. Okay, subsequent event is any event that occurs between the date of financial statement and the date of the auditor's report. There is some time from the date of financial statement and when the auditor's report is going to be issued. During that time, any event taking place is known as subsequent event. Okay, and also any fact that becomes known to the auditor after the auditor's report also comes under subsequent event only. The difference is some event are adjusting according to IS 10, some are non-adjusting. For adjusting, we have to adjust financial statement. Non-adjusting, we just disclose. Okay, so here adjusting event. Okay, you need to know the difference between adjusting and non-adjusting. You have to be able to differentiate between these two. Okay, the difference is adjusting means you have to see your recent financial statements and information, okay, to see whether there is any evidence that says that condition exists at the reporting date. Okay, already some condition must have existed at the reporting date. Okay, and then if there is any change or new information which comes related to that existing condition at the reporting date, then it is known as adjusting event. Okay, and you have to adjust the financial statement for that new information that you get. Examples of adjusting event: one is damaged inventory and doubtful receivable. Allowances for doubtful receivable, because at the date of the reporting date you know what is the position of inventory, you know your receivable. So either because of the new information after the reporting date, maybe uh, there is an increase or decrease in the allowance of doubtful receipts, so you have to adjust. Same for the damaged inventory. Next, regarding insurance claim, amount received or receivable, but you have been negotiating this at the reporting date, right? But the amount that you have to receive from insurance comes after the reporting date. Still it's a adjusting event, because at the reporting date negotiation was going on with the insurance. Okay, if the negotiation did not take place at the reporting date with the insurance, then it's a non-adjusting event. Okay, so basically you have to see the condition exists at the reporting date or not relating to that event. Next is determination of purchase or sale price of non-current asset, that is purchase or sold before the year end. Then agreement of tax liability and any discovery of error and fraud, revealing that financial statements are incorrect. All these are examples of adjusting event. Coming to non-adjusting event. Non-adjusting event are conditions which exist after the reporting date. Okay, you just have to disclose them in the note. Now, so this type of event, okay, they will not have any effect on the statement of profit and loss or statement of financial position. Examples are when you are issuing a new share or loan capital, major changes in the composition of the group, for example reconstruction, mergers, accusation, you just need to disclose. Losses of non-current asset or inventory as a result of fire or flood, because how do you know the reporting date? You cannot predict that the fire is going to take place, right? So maybe that fire took place after the reporting period, so it's a non-adjusting event due to which non-current assets are lost or inventory is lost. Strikes, government action such as nationalization, maybe the government took action after the reporting period, so at the reporting period there were no event, no condition existing, right? Purchase and sale of significant non-current asset, all these are non-adjusting. So then regarding subsequent event, what is the auditor's responsibility? There are two types of duty. One is known as passive duty, the other one is known as active duty of auditors. Active duty stays from year and date till auditor's report is signed. During that period, it is active duty. After the financial statement is issued, any event takes place, that is passive duty. Okay, active duty means auditors have to perform procedure to make sure the subsequent events are appropriately accounted for. Passive duty means no obligation exists to perform any procedure. Okay, but they must take action if they become aware of the event which can modify the opinion, auditor's opinion. If they become aware, if they are still not aware of the event, then it's fine. I mean, then there's no duty on the auditor. Okay, auditors does not have any responsibility to change their opinion or the financial statement. But if they are aware, action needs to be taken, especially if opinion could become modified because of the event. Now, so between the date of financial statement and date of auditor's report, these things needs to be done. Okay, number one, auditor should perform procedure to identify event that might require adjustment in the financial statement or even disclosure. Next, if it's a adjusting event which is material, but it's not adjusted for, or it's a material non-adjusting event but it is not disclosed, then auditor should ask the management to make the necessary amendment in the financial statement. Okay, if no adjustment has been made, no disclosure has been made, okay, then auditor should consider the impact on the auditor's report, whether modification is required or not, modification of the opinion. Next, these are the procedure regarding subsequent events. See, even after you have planned and performed the audit, still at the last stage, these are the last stage of audit: reviewing, completion and reporting. So subsequent event, there are procedures for everything. We have went through audit procedures for specific element like non-current asset, intangible asset. Now we are moving on to the later stage procedure. Here also we have procedure. Okay, but it is for subsequent event, specifically for subsequent event. Number one, you inquire the management. You see, remember audit procedure. I told you there are three things that is there. One is action, review, inquire, observe, analytical procedure, like that. Same we have here also. Then we have some source of evidence and assertion that we are testing, whether we want to see something is complete or not, whether we want to see whether something have occurred or not, right? We are testing assertion and evidence, source of evidence. So here source of evidence is management. You inquire management whether they are aware of any event, whether adjusting or non-adjusting, that needs to be included or disclosed. Next, again inquire management regarding the system, whether they have a system to identify such event after the reporting period. Then you can read minutes of members and directors meetings, because through minutes you can see whether they have anything upcoming. Okay. You can review accounting record like budgets, forecast, cash flow, management account and interim information to be aware of any event, right? Subsequent event after the reporting period. See, all this does not come at the planning stage of audit, okay? This procedure. Don't write this audit procedure when you're planning audit, when you're performing audit. We have finished already all those. Now we are in the review stage, subsequent event stage. Here we have to do this kind of audit procedure. Then again a written representation from management confirming that they have informed the auditor of all the subsequent event and it has been accounted appropriately in the financial statement. We have more. You can inspect the correspondence with legal advisors, because legal laws, if you have any claim against you, that is also a subsequent event. Then you review the progress of your known risk areas and contingencies. How is the progress? Is it getting worse? Is it improving? How is it? Consider relevant information which has come to the auditor's attention. It could come from any, like from outside source, from public knowledge, from the competitor, from the supplier, from the customer. All information is important here. Then inspect after date receipts for receivable. Inspect the cash flow, cash book for any payment and receipt that were not acquired at the year end. And inspect the sale price of inventories after the year end. Now, the next is, this is a passive duty, when the auditor's date and the financial statement, when the financial statements are issued. Here, auditor does not have any obligation to perform audit procedure, okay, after the auditor's report. But if they become aware of any fact, as I told you, they need to take action. And these are this action, okay. They will normally ask the client to amend the financial statement and reissue auditor's report. Once client amends financial statements, you also have to reissue auditor's report. You cannot rely on the same auditor's report, because auditor's report also will change, And once financial statements are audited, remember, again you have to audit those amendments. Those amendments needs to be audited and auditor's report needs to be reissued. And if management does not amend, what happens? And the auditor's report has not yet been issued to the client, auditor can still modify the opinion. Okay, before auditor's report reach to client, auditor still has time to modify their opinion if management does not amend the financial statement, even after the auditor's report. And if in case auditor's report has been provided to the client, then auditor shall notify the management and those charged with governance not to issue the financial statement before the amendments are made. Then, if client issues the financial statement, even after auditor saying them not to, then auditor shall take action to prevent reliance on the auditor's report. Then you have to take action that no one rely on that auditor's report. Okay. Then, in this case, you can seek legal advice. Okay. Because how much power does an auditor have to prevent someone from relying on their report depends on their rights and obligation. And to know this rights and obligation, better to seek legal advice. Okay. Then after the financial statements are issued, this is the last stage. Okay. Here, auditor does not again have no obligation to perform audit procedures. But here also, if they become aware of any information, they have to take action. Okay. To amend the auditor's report. Auditor have to discuss this with management and those charged with governance. Okay. If financial statements requires amendment. And Auditor should perform audit procedures on the amendments only to ensure that amendment has been done correctly. Auditor should review the steps taken by the management to ensure who is in the receipt of the previously issued financial statement. Okay, who is in receipt of the previously issued financial statement is informed. Okay. Now, auditor should issue a new auditor's report in this case, and they have to include emphasis of matter or other matter paragraph so that they can draw attention that financial statement and auditor's report has been reissued. And still, if management refuses to recall and amend financial statement after so many warnings, auditor shall take action to prevent reliance on auditor's report, same like the before one. Now, that was auditor's responsibility. Now, management's responsibility. What is management's responsibility? See, uh, okay. Management, okay, we have from subsequent event, we came to going concern. Okay, the next one is going concern. So we are done with subsequent event. So in going concern, what is the management's responsibility? See, it is management's responsibility to prepare financial statement. We all agree with it, right? So they must make a specific assessment of the entity's ability to continue as a going concern. Okay, this usually requires judgment. Management have to make a judgment about their future outcome, which is uncertain. And management is the one who's going to prepare financial statements on a appropriate basis. It could be going concern or breakup basis. If there is uncertainty over going concern, then it's a breakup basis. Okay, what is breakup basis? Breakup basis means all assets and liabilities are reclassified as current and revalued at net realizable value. Okay, and if there is any further provisions for liquidation such as redundancy and legal costs, this may be they may also be required. Now, going concern disclosure. Okay, required by the directors. So in that disclosure, number one thing is whether there is any material uncertainty relating to future of the company. Okay, they have to disclose this. This disclosure should explain what is that event, what is that principal event that is casting doubt over the future of the entity. Okay, and how management is dealing with it. And they should also disclose that company is unable to realize its assets and liabilities in the normal course of business. Number two, okay, second disclosure is whether directors are unable to assess going concern in a usual way. For example, if your time period is less than 1 year, it's not possible for someone to say whether business is going to be a going concern or not if the period is less than 1 year from the date when financial statement has been signed. Okay, so this fact also you have to disclose. And number three, whether financial statements are prepared on other basis other than going concern basis should be disclosed. Now, auditor's responsibility for going concern. Auditor's responsibility is to get appropriate and sufficient evidence regarding the management's appropriateness of going concern. That means if management is using going concern basis to prepare financial statements, you have an auditor have to have evidence to see whether it is appropriate or not. And then you have to conclude whether materiality uncertainty exists or not regarding going concern of the entity. And report accordance with ISA 570, that is going concern. These are the going concern procedures. Earlier we went through subsequent event procedure. Now we are going through going concern procedure. Going concern and subsequent event are two different things. Okay. So now, evaluate management's assessment of going concern. Okay. It is the management, remember, who has to assess whether their entity is going to be a going concern or not. Once they have assessed, then you evaluate. Auditors evaluate that. Next, and assess the same period that management has used in the assessment. Okay, and if it's less than 12 months, you have to tell the management to extend it. The assessment has to be extended at least up to 12 months. And then you have to consider whether management's assessment includes all relevant information. Now these are the audit. Wait a minute. Audit procedures to perform when there's a doubt over going concern. Number 1, analyze and discuss cash flow, profit, and other relevant focus with management. Why? See, it is through your cash flow you can say whether it's a going concern or not. If your cash flow suffers, most probably there is a doubt over going concern. If your profit suffers, doubt over going concern. If other focus says gives a negative result, doubt over going concern. That's why we have to analyze cash flow, profit, and other forecast. Again, analyze and discuss the latest available interim financial statement. Then review the terms of debenture and loan agreements, because if you fall short of your loan long-term liability, that also could be a doubt over going concern, right? Next, read minutes of meetings for reference to financing difficulties. Then inquire the entity's lawyer regarding any litigation and what could be the estimate, right? Estimate of the financial implications on the financial statement. Confirm existence, legality, and enforceability of arrangements to maintain financial support from third parties. Okay, you have to see whether through any arrangement whether third party could give that support to the management or not, entity or not. And also you have to see whether the third party who is going to give the financial support to the entity has the financial ability also or not. Okay. Review subsequent event to identify those that either mitigate or affect the entity's ability to continue as a going concern. Then review correspondence with customer regarding any dispute. Okay, that means it could affect your future recoverability of debt or future sales. If your future sales decline, if your recoverability of debts decline, then doubt over going concern. Correspondence from supplier, whether there is any issue regarding the payment, whether suppliers are being paid or not. Because if suppliers are not paid on time, they might restrict or withdraw credit or even the supply from the entity. Then review correspondence with bank, because through bank you can say whether bank loan and overdraft has been recalled or not. Get a written representation from management regarding what are the plans for the future and how they are going to address going concern issue. Okay, so therefore identify procedures to obtain evidence about the amount of cash. That means how much cash you are going to receive, how much cash you have to pay, because this will tell you your cash flow problems. Okay, if cash flow problem is there, there's a doubt over going concern. So you have to make sure that your procedure is towards collecting evidence regarding cash only, cash flow. Okay, now audit conclusions and reporting. What could be the impact on the audit for going concern? Okay, so based on the evidence, auditor have to use their judgment. Okay, whether there is a material uncertainty or not regarding entity's ability to continue as a going concern, and basis for preparing financial statement, whether it is appropriate in the circumstances or not. Now we are going to go through some situation, impact on the auditor's opinion and the report. Situation is there is no material uncertainty regarding going concern, so impact will be unmodified. Okay, financial statements gives true and a fair view. Impact on auditor's report, no impact. Coming to the next situation, materiality uncertainty exists, but it has been disclosed by the management, again unmodified, and impact will be there. What is that impact? You have to include this line, material uncertainty relating to going concern. You have to disclose now. Third situation, material uncertainty exists but you did not disclose it also. Then modified opinion. Modified could be either qualified or adverse. Okay, and here also in the report you have to include this basis for that opinion, why it is qualified or adverse, and also explaining going concern issues also that management did not disclose. Fourth situation, company is not a going concern, but they have, okay, and they have prepared the financial statements on a breakup basis, which is correct. If you're not going concern, don't prepare financial statements on a going concern. That's what they have done, and appropriately they disclosed it also, so opinion will be unmodified. See, when you disclose something appropriately or adjust something, opinion will be unmodified. The issue comes when something has not been done when it should be done. In the report, emphasis on meta paragraph, because company is not a going concern. Then company is not a going concern and they did not even, but they still prepared it on a going concern basis, modified opinion, and it's adverse. Okay, and impact on the auditor's report will be basis for adverse opinion, and why management failed to disclose going concern issue. Okay, next, here the assessment of period is less than 12 months, so it will be a disclaimer of opinion. I'm sorry, it's modified. Okay, it could be qualified or it could be disclaimer. It will be disclaimer if they are not able to obtain sufficient appropriate evidence, otherwise it's qualified. Okay, and here, so the situation is less than 12 month, the assessment period, and also management is not extending the assessment also, they're unwilling. Okay, in the auditor's report, basis for qualified or disclaimer of opinion. Okay, and why they did not get sufficient appropriate evidence. Okay, there are some indicators of going concern risk. These are the indicators that you need to look for in the question given to you in your exam. Whether there are rapidly increasing cost, whether shortage of supply, adverse movement in exchange rate, business failure among supplier or customer, loan repayment falling due in near future, high gearing, approaching borrowing limit, loss of key staff, loss of key supplier customer, technical obsolescence of product range, impact of major litigation, other fundamental uncertainties, significant changes to laws and regulations affecting entity, and deteriorating financial ratios. Okay, there are some 14 indicators, I think. So that's it for this lecture. This is a very short and sweet lecture. Okay, no questions in this. In the next lecture we'll be doing questions. Okay, because next question is just a continuation of this, which is also a part of completion and review. So in the subsequent event, there are two types of duty, active and passive duty. Active duty is from the date of financial statement and after the reporting period and auditor's report. Passive duty is from the date of auditor's report up to the date when financial statements are authorized for issue. And make sure client complies with IS 10. IS 10 means if it's an adjusting event, you adjust, and if it's non-adjusting, you disclose. Going concern is make sure that financial statements are prepared on an appropriate basis. Okay, if it's a going concern basis. If it's not a going concern, breakup basis. And disclosure has to be made regarding that uncertainties and impact on the report. What type of opinion will it be? Right? We went through that, the list of that table. So that's it for this lecture, and I shall see you in the next lecture, which is continuation of this. And don't forget to subscribe to my channel if you haven't subscribed, and you can watch all my audit lectures in the playlist AAA lecture and download them from my channel, which you will get if you go to my about section. You can go down and click on AAA lecture and get all the slides of AAA. Thank you and see you in the next lecture.